The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to ACECRT's July webinar titled Guide to the Markets and Economy, courtesy of JP Morgan. We appreciate all you taking the time to join us today. This webinar is part of our monthly webinar series, and today we will be taking a look at the current state of the economy and financial markets. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then, at the end of the presentation, we will take some time to go through these. With that said, I'd like to introduce our guest speaker from JP Morgan, Dr. David Kelly, Managing Director and Chief Market Strategist for JP Morgan Funds. Dr. Kelly has over 20 years of experience in the industry and provides valuable insight and perspective on the economy and markets to thousands of financial advisors and their clients. He is a keynote speaker at many national investment conferences and is also a frequent guest on CNBC and other financial news outlets, and is widely quoted in the financial press. I would like to thank Dr. David Kelly for joining us today, and with that said, Dr. Kelly, I'll now turn it over to you.
Okay, thank you very much, and thank you everybody for taking time this afternoon to call into this call. So what I wanted to do is take the next probably 30 minutes or so to talk about how we see things right now in the markets and in the economy. It's been a very good few years for the stock market. It's actually been, we've now been recovering as an economy for 5 years, although the economic recovery hasn't felt nearly as good as the stock market recovery. But I guess with markets having moved up this much, a lot of investors are wondering, well, you know, should I still be overweight stocks? Should I still be putting money into the stock market given how high it has already moved or how fast it's already gone up? Equally, I think a lot of people are wondering about the bond market. We went into this year thinking that interest rates would likely go up, and instead in the first 6 months of the year, they went down. But where do we go from here on interest rates? And I think before answering the stock market question or the interest rate question, it really is a matter of, you know, I think the most important thing is the economy itself. I've always believed the secret to success in investing is not seeing the future with some kind of mythical vision. It is seeing the present with some kind of clarity. I think it's very important to look at the overall economic and investment landscape as it is right now and figure out what's in balance and what's out of whack, and use that as a way to form some judgments about where we're going. So with that as a backdrop, as I said, I'm going to talk for about 25 minutes about the economy and markets, and I'm going to use these slides that I hope you can see on your screen there to do this. And then I'd love to open it up to you for any questions. So just to lay out the agenda of what I want to talk about here, first of all, I want to talk about the U.S. economy. We got some new numbers on that yesterday, and I think the basic theme is we think things will actually improve in the next year or two, but there are some long-term issues which are important. I think with interest rates, despite the respite that we've seen in the first 6 months of this year, I think rates are likely to go up. If you turn to the stock market, we do maintain a cautious overweight to U.S. stocks. So let me be clear about that. We still think it's better to be overweight stocks and underweight bonds and underweight cash within the United States. But I want to talk about exactly why we feel that way. We also feel strongly about the importance of diversifying overseas. And I want to talk a little bit about European and emerging market equities. And finally, I want to talk about what sounds like a slightly, I don't know, wonky subject, but portfolio adjustments as you approach full employment. I think the one thing that Americans probably don't realize about the economy today is this. We're actually pretty close to normal in the economy. Most people actually think, in America, actually think we are in recession or close to recession, but the truth is the unemployment rate today is the same as its average over the last 50 years. We're not that far from normal. It has been a slow expansion, which leaves a lot of people feeling pretty grumpy. But overall, the economy is improving. But it also means there's a limit to how much more the economy can improve without running into some inflation problems. And I think there's some adjustments that people need to make. So those are the things I want to talk about. And then I'd like to open up for any questions. Let me start by talking about the economy itself, and I apologize because we had to get these charts approved before yesterday's GDP numbers. So this is before we got the GDP report, but I can use this as a basis for what I was going to talk about anyway. GDP growth in the over the last 50 years, and you can see this in on the left-hand side, that the pace of growth of the economy has been about 3%. But so far, this expansion, and we're now in the expansion's 6th year this month. This is the 6th year of expansion we're in right now. The economy has only grown by 2.1% on average per year. And actually, when they revised all the numbers going back historically yesterday, we ended up with the same result. We've grown 2.1% on average. When I think about the American economy today, it reminds me, I live in Boston, it reminds me of a Yankees-Red Sox baseball game. If you've ever watched the Yankees and the Red Sox battle it out, the games tend to be very slow, but consequently they end up being very long. And this expansion has been very slow, but it could consequently end up being very long. We're already in the 6th year of an expansion. If you go back to the Civil War, there have been 34 economic expansions in America since the Civil War. This is now the 6th longest, believe it or not. So it has been slow, but it still has got some room to grow. GDP growth was reported as minus 2.9% initially for the first quarter, but yesterday they revised that up. Now they say it's only negative 2.1 for the first quarter, and they revised up the second half of last year to quite healthy numbers, and they said that the economy grew by 4% annualized in the second quarter of this year. So the one piece of information I think is important out of yesterday's numbers, it does show the economy has grown a bit faster in the last year. And we think that will probably continue. I mean, if you look at some of the short-term indicators in the economy, we have some of them here, things like vehicle sales and housing starts and capital goods orders. We are still seeing some improvement. There isn't much dragging on the economy. We don't have much fiscal drag right now. We don't have any tax increases that kicked in this year. State and local governments are looking a bit better. There's plenty of pent-up demand for houses. There's still plenty of pent-up demand for cars. There are a lot of old vehicles out there. Businesses have got a lot of cash to put to work, and they need to do some capital spending. And you know, when we look at things like unemployment claims this morning, which came down to, on a 4-week moving average, the lowest since the mid-2000s, or if you look at consumer confidence, which is gradually moving up, all of these things suggest the economy is picking up. And you know, I think we've done 2% growth over the last 5 years. I think we could pick up to about 3% growth over the next 2. And I think that's the good news. But there is some bad news. I mean, I have a colleague of mine who said this, that the essence of our forecast is that over the next 2 years, 3 is going to be the new 2, and in the long run, 2 is going to be the new 3. Let me explain what he means, because I think it's kind of a neat way of putting it. If you look, let me head back 2 pages here. If you look at this chart, in the 3% growth in the long run, that's what we've done in the last 50 years. We would have been doing 2% over the last 5 years. I think we'll pick up to about 3 because I don't think there's anything dragging the economy in the short run. But going forward, we really have a problem in this country. We've been so focused on demand. Everybody's saying, well, can we get shoppers to buy, and can we get businesses to spend and buy stuff? We've been so focused on the demand side of the economy, we've forgotten a little bit about the supply. I mean, what is it that causes the supply of stuff in the economy to grow? Well, in order to produce more as an economy, in order to produce more, you need 2 things. You need workers, and you need stuff for them to work with. In other words, you need labor and you need capital. Now, one of the problems we have is that we haven't been building enough capital. We haven't been investing enough in new plant and equipment and structures. You can see in this chart here, you can see how investment spending has slowed down in growth terms. And of course, a lot of the stuff we already have is depreciating. So if you look down the bottom left-hand side of page 5, what that really says is we're not building as many, we're not giving workers today as many new computers or as many new office buildings or as many new transportation vehicles or industrial equipment as we did 10 years ago, and we're certainly not doing as much as 20 years ago. And because of that, we expect that it's hard for output per worker to go up. So one of the problems is that we're not giving workers the tools to produce more stuff. The other problem is, if you look at labor force growth, it's just fallen away. One of the big problems that we're facing right now, and I don't think that people are aware of it enough, is that between 2010 and 2012, the number of people celebrating a 65th birthday jumped by 1 million people in this country, just in 2 years. This is the start of the baby boom hitting 65, but it's happened with a vengeance over the last few years, and that's essentially stopped all labor force growth. We've got no growth in labor force. Now, we can still get more workers at the moment because the labor force is defined as those people who are working or those people who are looking for a job. And there's still plenty of people looking for a job. But once we've used up the people who are looking for a job, once the unemployment rate is down to as good as it gets, or so to speak, for the long run, then the number of people of working age is just not growing fast enough. And that is going to be a drag on the economy going forward. So, you know, it's mostly good news. I think the economy is picking up short term. Everything that we look at suggests that that is the case. But I do want people to be aware that in the long run, the economy can't grow quite as fast as it has done in past decades. Let me talk a little bit about the Federal Reserve. The Federal Reserve met yesterday, and they would have been looking at a lot of things. One of the things they'd be looking at was the unemployment rate, and you can see that the unemployment rate has now come down to its 50-year average. You can see that in this chart here. The labor market's continuing to tighten. Again, I don't think that Americans know this. If you look at the left-hand side of this chart, the unemployment situation this time round is exactly the same as every other recession and recovery. Every recession, the unemployment rate jumps up, and every recovery comes down more slowly. But it's done that. It's fallen by about 0.8% per year, and now we're down to 6.1%. And we're going to get a new number tomorrow, and maybe that's 6.1, maybe it's 6.0. We'll have to see. But overall, this economy is producing jobs fast enough to push the unemployment rate down. Meanwhile, if you look at inflation, not too much is going on with inflation right now. This chart over on the left-hand side, you see that the orange line is called overall inflation or headline inflation. The gray line is the inflation rate when you take out food and energy. Now, a lot of times people give me a hard time. You know, why do we take out food and energy? I mean, we don't drive a car, we don't feed our kids. No. The reason you take out food and energy is because they're very volatile, and they tend to sort of just, you know, they're up one year and down the next year. But if you look at inflation outside of food and energy, you look at the core inflation rate, that's much more stable. And right now, if you look right over the right-hand side of that little chart there in inflation, you see just a little bit of a tick up to about 2%, well, I guess 1.9% in May on core inflation. And that's kind of where we are. I don't think inflation is going to take off anytime soon. But I think it stops falling in the United States. If you look at things like employment costs, which came out today, they're beginning to rise more quickly. If you look at things like rent, there's very little rental property available in America, and that's pushing up rents right now. And so I think inflation is not going to be a problem for this year, but I think it is picking up a bit. So the Federal Reserve knew that when they got together yesterday, and they had their meeting that they do every 6 weeks, and nothing. There was no real surprises there. In terms of what they decided to do. They have been building up their balance sheet. You can see that over on the left-hand side of this chart. You can see the huge growth in the assets of the Federal Reserve. This is a lot of Treasury bonds and mortgage securities they're buying, trying to pump money into the system. This is what's called quantitative easing, or QE. They're still doing that, but they're doing that at a reduced pace, and by October they'll be all done with quantitative easing. And at least that's what they expect to be the case. There's still a question about when they raise the federal funds rate, and you know, I don't want to get into too many details, but as I see it, the problem I have with the Federal Reserve right now is a little bit like a problem I run into every December. I like, one of the things I like to do for every Christmas is I make a nice big fruit cake. I come from Ireland, and Irish people love fruit cake. My family, on the other hand, is American, so they do not. And so there's a great crinkling of noses as I make this fruitcake. But anyway, I have this recipe, and I pulled it out from the internet years ago, and I can't find another one or another good one, so I sort of stick with it. But there's a problem with this recipe. So you make the fruitcake, you put in lots of sultanas and raisins and glazed cherries and sugar and eggs and whiskey, and it's really wonderful. But anyway, you make this cake, you stick it in the oven, and it says put it in the oven at 300 degrees for 4.5 hours. Now, I will tell you from personal tragic experience, that doesn't work. If you leave the cake in the oven at 300 degrees for 4.5 hours, you will burn the cake. And the reason I bring this up right now is because I think the Federal Reserve policy right now is ignoring the fact the unemployment rate has come down so much, is ignoring the fact that inflation seems to have fallen to a trough and is beginning to rise, is ignoring the fact that economic growth looks like it's picking up over the next 2 years. And I think Federal Reserve policy, in short, is designed to burn the cake. One of the things they show in their forecast, and we have this down on the right-hand side, bottom right-hand side of this page, page 9 of this presentation here, is They show the federal funds rate, where they expect it to be at the end of each year, and by the end of 2016, they think it's only going to be at 2.5%. But they think by then, they think the unemployment rate is going to be down 5.3% by the end of 2016. They think inflation will be up to about 1.8%. I personally think the economy is improving faster than that. I think by the end of 2016, unless something happens to this economy, we're going to be looking at unemployment in the mid-4s and inflation between 2 and 3%, maybe closer to 3. But what's really remarkable to me about this is not just that forecast, but it's the fact that they still intend, even when they've reached their targets, to be running the federal funds rate about 2.5%, because in the long run, they know interest rates need to be higher. They're just so scared about raising rates too early that they're going to raise them too late. And that means we probably will end up with some inflation or asset bubbles. And I think it's important to bear that in mind. And because of that, frankly, I think interest rates are going to go up. Now, they haven't so far. If you look at this chart here, take a look at it. It goes back to the 1950s. And the light blue line on top shows the 10-year Treasury yield going all the way back to 1958. And you can see how low it is. I mean, at the end of June, it was 2.5%. And basically, that's where it is today. But you can break down an interest rate into two components. It's the real rate, and then there's the inflation. I mean, the real rate is when you take out inflation. But it's not just that inflation is low today. It's also the real interest rates. Even taking into account inflation, interest rates are low. But if, I think one of two things is going to happen here. If the Federal Reserve persists in their policy of keeping interest rates this low all the way into the middle of next year, I think you're going to end up with some inflation, and that's going to push up long-term interest rates. So they keep short-term rates low, but they can't stop long rates from going up. And I think that's what would happen. If, on the other hand, they decide they're going to raise short-term interest rates early next year, I think that's going to push up real interest rates on long-term bonds, and that's going to push up long-term interest rates. So either way, I think interest rates are going to go up in the second half of this year and next year. Now, you might ask, well, if you're so sure interest rates are going to go up in the year ahead, why have they not gone up already? And we're looking at this, obviously. It's a big question for 2014. Why did interest rates actually come down in the first 6 months of the year? And we think that it's not because the bond market thinks we're going into a recession, and it's not because people are worried about deflation, and it's not because people are just hiding out in treasuries because they're scared to invest anywhere else. We just don't think it's any of that. What we think it is, in fact, is a mismatch between supply and demand within the bond market. I mean, first of all, where does the supply of bonds come from? Well, for treasury bonds, the supply comes from the government running big budget deficits. And up at the top right-hand side of this next page here, you can see the federal budget deficit, and you can see how it's come down. I mean, it has. I mean, people aren't told this because it comes under the heading of good news, but and good news is not reported in the U.S. media. There's a prohibition against that. But the deficit has come down from about 9.8% of GDP, which is about $1.4 trillion back in 2009, to about $500 billion today. So it's come from $1.4 trillion down to $500 billion. That's a big drop, and the big drop in the deficit means there's fewer new bonds being supplied to the market. That's what's going on one side. And the other side, you've got all these people buying these bonds. I mean, if you look at this chart here, look over on the right-hand side. Look who's bought bonds in the last year. The single biggest buyer of U.S. Treasuries has been the Federal Reserve. The Federal Reserve has accounted for most of all the total purchases of bonds in total. We've also had foreign official purchases, from, for example, foreign central banks. We've got some private investors who don't like the look of Japanese bonds or German bonds, and so they buy U.S. bonds. But the main thing I'd say is, I think it's a distorted market, because I think this is not a lot of individual American investors deciding they want to buy Treasury bonds because they think they're a good deal. It's mostly about central banks deciding they're going to buy bonds in the U.S., and that's pushing down rates directly, or central banks in Europe and Japan buying bonds, pushing down local interest rates, and forcing private investors to buy their bonds somewhere else, namely in the U.S. It's an artificial market. But what does that mean from here? Well, from here, one thing that's not going to happen is that our political system has really ground to a halt here. We're not going to see any further deficit reduction, so the supply of bonds should be about the same. But if you look at the demand for bonds, the Federal Reserve is going to stop buying bonds altogether in October, except to replace maturing bonds. So all that demand is going to go away, and I think if the demand for bonds goes away from our Federal Reserve, and also if I think the Federal Reserve itself realizes that it's going to have to raise short-term interest rates, I do think it's going to push up long-term rates. So, on the next page here, we show what's happened so far this year, and what happened last year in the bond market. Last year was the gray bars. This year is the blue bars. And if you look over in the far right-hand side, you can see the blue bars are mostly positive. In fact, they're all positive. This has been a good year so far for the bond market. Last year wasn't so good. But going forward, I'm nervous. I would still, I think going forward, the situation is going to be much more like last year than this year. Now, last year you could still make some money in high yield. I think you may make some money in high yield this year too. I think maybe floating rate makes sense also because floating rate bonds, and that's right at the bottom, don't tend to move much one way or the other in terms of price. But particularly with Treasury bonds and maybe some municipal bonds, some high-quality corporate bonds, I try to be underweight those areas in a portfolio relative to a normal portfolio. I'm not saying zero weight them. I just say relative where you'd normally be. I'd say be a little underweight bonds in general, and particularly Treasury bonds, if you think the economy is improving and the Federal Reserve is getting out of the bond buying business. All right, let me talk a little bit about the stock market. One of the most annoying, if you ever turn on CNBC and you hear some people talking about the stock market, admittedly I do this myself, so I suppose people in glass houses should not throw stones. But you hear all these annoying phrases, and one of the most annoying ones is, oh, all the easy money's been made. When it comes to the stock market, when was it ever easy? It certainly wasn't easy back in 2009 to get invested in stocks, given the huge financial chaos at the time. Since then, of course, a lot of the risks to the economy have diminished, but also stock prices have gone up, and so it's still a close call. But as we think logically about it, we still would have a positive view on U.S. equities, and let me explain why. First of all, earnings look pretty good. This chart here on the left, we show the earnings season. It shows how, or earnings going back really to 2001. And you can see how earnings fell very dramatically in the last recession, but they have fully recovered, hit new highs. And in fact, the first quarter was down a little bit from the fourth quarter, but I will tell you, with now about 2/3 of the earnings season in for the second quarter, it looks like about $29 even for the second quarter, and that would be the highest number we've ever seen on earnings per share for a quarter. So earnings continue to do well, and I think that's a big positive. If you turn to the next slide, if you look at valuations, I guess with valuations, I'd say there are two stories, one in absolute terms and two relative to bonds. In absolute terms, if you look at the table up there, look at the numbers for the latest reading of things like price to earnings or dividend yield or price to book, and then look at where it's been on average over the last 25 years. And it tells you, and that's over on the right-hand side, and it tells you the stock market is no longer cheap. In fact, it might be a touch on the expensive side in absolute terms. But John Donne said that no man is an island, and no asset is an island either. You can't just judge these things individually. You have to look at stocks relative to available returns elsewhere. And given very low long-term interest rates, stocks still look cheap. One of the ways you can look at this is down the bottom right-hand side of this page, where we show the earnings yield on stocks versus the BAA bond yield. Now, the earnings yield on stocks is simply the price-earnings ratio turned on its head. It's the, given for a given stock, how much money do you earn in total earnings, dividends and retained earnings as a share of the price. And normally the earnings yield on stocks is a bit below the yield on BAA bonds, but right now it's well above it because the interest rates are just so low. And that tells us that in relative terms, and I think that's really all that matters is in relative terms to some extent, in relative terms, the stock market is still somewhat cheap. And then the third thing that I think is important is there's a lot of cash to be put to work. This chart here shows that the amount of money sitting on the sidelines. It's a colossal amount of money. And down on the bottom right-hand side, you can see the number 10.910, $10.9 trillion sitting in short-term accounts, essentially all earning zero. I mean, it's about $30,000 for every man, woman, and child in this country is sitting in an account earning nothing. That is very high. It's higher, even relative to the economy, it's high. You can see we show a picture of the money supply divided by GDP, and you can see it's well above its normal level. And I think that means that money will be flowing into equity markets. You know, we think a lot about should we still be overweight equities. And the way I think about it is in terms of traffic lights. We think there's still a green light on earnings. We think earnings will continue to grow, and there's a green light on the economy. We think that there is a yellow light on absolute valuations. They are no longer cheap, but there's a green light on relative valuations. Relative bonds stocks still look cheap, and there's a green light because just because of cash sitting on the sidelines. A lot of money needs to go to work, and we think that as people put money back into the stock market and into the bond market, that will help stocks move up. All right, I'm going to skip forward here a little bit and just talk a little bit about what's going on around the world. This chart here is one of my favorite charts. It's a rather bright chart. The red is bad and green is good. Let me say that right at the outset. It's a purchasing manager index chart, and it looks at the purchasing manager index for various developed countries, which we show up top, and various emerging markets, which we show down below. And as I said, red is bad and green is good. And what you can see is this chart has gradually gotten greener. And the big reason it's gotten greener is because the European debt crisis has really drifted away here. And that's allowing Europe a chance to grow. But also if you look at numbers coming out of China and Japan and India, we're seeing growth. We're seeing growth more generally around the global economy. We are going to get some more numbers on all of this tomorrow, so it'll be very interesting to see how these numbers come in for July. But the early estimates are pretty good. I do think when it comes to investing abroad, I think there's a strong case for Europe. One of the things we show on this chart here, and I'm not going to go through the details, but we show that the interest rates on long-term bonds in Europe have come down a lot because things are more calmer. There's a lot less austerity being used in Europe before. Their deficits are coming down, but much more slowly, and that's actually giving them a chance to grow. But to me, the really interesting thing is on this chart here on page 22. Up on the top left-hand side, you see that chart up in the top left? That shows the unemployment rate in the Eurozone and in the United States. Now, when we put together this slide, we only had May numbers for both of these areas. But I will tell you, as of this morning, the Eurozone unemployment rate is now 11.5%. And as of June, the unemployment rate in the United States was 6.1%. Now, there are two things to bear in mind here. Now, 11.5 still sounds like a horribly high number. It is. But it's coming down. It's clearly coming down. Europe has been growing for over a year right now. Their economy is finally back in expansion mode. But the other thing that, to me, is actually ironically very challenging or very promising here is that European unemployment is so high. Because it is so high, that is causing that gives them room to grow. I mean, we're already back at our average unemployment rate for the last 50 years. We've only got a year or two more of above average growth, and we'll be at full employment. But for Europe, they can grow for a long time before they're at full employment. And that means they can grow for a long time before they ever have to worry about inflation getting out of hand. On emerging markets, I'm not going to go through this in detail either. You're welcome to take a closer look at this slide. But the main point I make is we look at population, how young is the population, and how much are they investing. Ultimately, as I said, long-term economic growth is a matter of capital and people. And emerging markets are spending far more of their economy or their overall output, devoting that to investment spending. That's giving their workers the tools to grow with. Also, because they've got such a much bigger, younger population, that gives them a much stronger growth in the labor force right now. I think that combination will allow emerging markets to continue to grow. And the other thing I'd mention is this chart here. This may be the single biggest reason why I think people really should just stop and think and put some money in Europe and emerging markets. On the left-hand side, we show earnings for the United States and for emerging markets in blue and for Europe in purple. On the right-hand side, we show PE ratios for the United States in gray, emerging markets in light blue, and Europe in purple. So let's start with on the right-hand side. Look at those PE ratios. The U.S. has now recovered. It's up to the highest level it's been more or less in the last 10 years. That's fine. Europe has also done the same thing, and Europe is at the highest level it's been in the last 10 years. But emerging markets are still very low. People are not trusting emerging markets, and that means that I think there's an opportunity to make money just because PE ratios go up, price-to-earnings ratios go up in Europe, in emerging markets. But over on the left-hand side, you can see not only our PE ratio is going to go up, but also earnings have a chance to grow. In the U.S., this gray line, as I said earlier, the United States is at an all-time record high in terms of operating earnings. But that's not the case in Europe or in emerging markets. Both of those have seen earnings actually fall over the last few years, and we think there's a lot of potential for a cyclical recovery in Europe to push those earnings up, and for a long-term recovery in emerging markets to put earnings up. I mean, I know you can't turn on the television without seeing some awful thing going on in countries like Thailand or in the Ukraine or Iraq or Gaza, and that's, you know, whenever there's bad news in emerging markets, it always makes the headlines. But the truth is, these countries will grow faster than the developed world in the years ahead, and people need to have some investments there. But most of all, and I think I'll just end on this chart here, most of all, people need to be balanced. This chart here goes back over the last decade. It looks at different returns from different asset classes. And through the middle of it, we show an asset allocation fund, which is just all of these, it's sort of a weighted average of all of these pieces, where you rebalance at the start of every year. And if you look over the far right-hand side, you can see what each of these asset classes have done over the last 10 years. And you can see within, you know, if you had just a balanced portfolio, an asset allocation portfolio, you would have done 100.2% if you'd just been balanced and rebalanced every year. And, you know, I think that is, I don't think going forward we will do quite that well over the next decade, because I think the market has gone up a lot over the last few years. But I do think that going forward over the next 5 years or over the next 10 years, a diversified portfolio of long-term investments will beat cash. Cash has had miserable returns over the last decade, and frankly, it's returned you pretty much nothing since 2009. That was, 2008 was the last time we got anything other than a tiny decimal of return on cash. And it doesn't make sense to keep money hoarded in cash at zero, or at least not long-term money, I don't believe. I think, the one other thing I'd say about this is the reason interest rates are so low is the deliberate efforts of the Federal Reserve and the Bank of Japan and the Bank of England and the European Central Bank. They are overdoing it in terms of monetary ease. And in some ways, they're fixing the investment game. They're fixing it so that you can't make money just through savings. You've got to make money through investing. And I think that's, you don't fight the Fed. And when cash is paying you nothing, it's important to get invested in something. And right now, there are lots of issues out there, and I do want to open this up for questions to try and address some of those issues, and I'm sure you've got some questions. I hope you do. But even with the worries that we have about the world right now, given how little cash is paying you, and given that the global economy is growing, I would still be invested in long-term assets in a diversified way right now, rather than hiding out in cash, because there are risks in the world. There are always risks. But cash is still paying you nothing, and nothing is a very bad return to get on your hard-earned money. Anyway, those are the main points I wanted to make, and now I thought perhaps I could open up for any questions. Do we have any questions out there?
Thank you so much, Dr. Kelly. That was all very insightful information. We'll now start addressing some of the questions that have been filtering in, and please remember that if you do have any questions, you can submit them using the Q&A tool on your webinar menu. Now, as we wait for questions to filter in, I'd like to take a minute to let everyone know that you can stay up to date on the latest retirement plan news and events via ACECRT's Facebook, Twitter, LinkedIn, and YouTube pages. Links to these social media sites can be found on the ACECRT website at www.acecrt.com. With that said, we'll now move on to our first question. It says, all this data is interesting as it relates to the economy. Do you have any takeaways on how to utilize this knowledge toward a retirement plan portfolio, generally speaking?
Yeah, I mean, obviously I spent a lot of time talking about the economy as a way to build up to this. But so what you start with is you start with an appropriate portfolio for where you are in life. And I think that is really something that I think we generally recommend people talk with financial advisors to get a sense, or their plan sponsor to get a sense of what an appropriate portfolio is for where they are in life. Once you've got that sort of appropriate balanced portfolio, where should you be overweight or underweight? So what we're really saying here is, given that interest rates are likely to rise, rising interest rates will tend to hurt the bond market. So I'd say relative to that normal portfolio, I'd be somewhat underweight in bonds. Now, I'm not going to give specific percentages here, but just to as a for instance, if you had 40% of your money in the bond market, maybe you ought to have 35% or 30% in the bond market. Equally, I think you should be a little overweight where you'd normally be in the equity market. So maybe if you had 40% of your money in the equity market normally, maybe it should be 45 or even 50%. I also think that given that the United States is running out of room to grow above trend here, but given that there is room for above trend growth in Europe for a lot longer and for emerging markets almost indefinitely, I would be a little bit overweight international and particularly emerging markets. So, it may be normally you would have, say, 40% of your equity money invested in international stocks, or maybe, let's say you have 30% normally in international stocks. I'd say, well, maybe that should be 40%, and a good chunk of that should be in emerging markets, and a good chunk of that should be in Europe. Within the bond market, whatever bonds you have, I think it's important to be a relatively short duration. So I like short-term bonds more than long-term bonds, but also I think things like high-yield bonds and emerging market debt make a lot more sense right now than things like treasury bonds or TIPS or high-quality corporate bonds. And then I also think it's important to have some alternatives in there. I think one of the alternatives I've mentioned, which I sort of skipped over, is commodities. But I think if you look at commodity prices and inflation, which we showed down the bottom right-hand side of this chart here, as commodity prices go up, as inflation goes up and down, commodity prices actually go up and down much more. And so I think there is a possibility of a bout of inflation over the next year or two if the Federal Reserve is too slow to tighten. But I think commodities are a good way to hedge against that inflation. So it's mostly about balance, but with an overweight towards equities, towards global equities, and somewhat of an underweight towards fixed income.
Great. Thank you, Dr. Kelly. The next question we have coming in, what are some potential real risks that could cause the economy to decline or go into recession?
There are a few things that could go wrong. I think the biggest risk right now that we face that I'd say is almost a probability is the Federal Reserve waits too long to raise interest rates. And as they raise interest rates, they find the economy doesn't slow down, and the unemployment rate actually could come down all the way to below 5% to somewhere in the 4s. But as that happens, wage growth picks up, overall inflation picks up, asset prices pick up, and then the Federal Reserve gets scared and they have to raise interest rates rather sharply to deal with this, to prevent inflation, and that causes a recession. Another possibility is you have some bubble in the economy itself emerge. Now that has not happened yet, but it could be that we overbuild or overbuy or whatever, and some correction in some industry causes a problem. So those are things within the U.S. I think around the world there's a problem with Chinese economic growth. I think the Chinese are trying to move to a more service-based economy, but they have too much money in their real estate sector. I think they're overbuilding on real estate, and I think that I think there's a danger as they slow down their growth in real estate, and as their export growth slows down a bit, also because the yuan has gone up a lot in recent years, and that's slowing their exports. It's possible that China could have an economic crisis or even a financial crisis. And then I also worry about what's going on in sort of the crescent of violence that stretches from Pakistan all the way through Afghanistan and Iran and Syria and Gaza, and then on to Egypt and Libya. In all this horribleness and hatred, there is some risk of something that could affect oil prices, and rising oil prices or spiking oil prices have often been a cause of recession in the past. I have to say most of these things are possibilities rather than probabilities. But sometimes people ask me, what keeps me awake at night? You know what? The thing is, I'm not scared of what keeps me awake at night. What I'm scared of is what wakes me up at night. Have you ever had the experience of waking up at 2 o'clock in the morning because you think you smell some smoke, or being woken up from a deep sleep by a phone ringing? Those are the things that really scare you, and for good reason. It's the thing that surprises you. And if you go back over the last decade, think about Lehman Brothers and 9/11. A lot of that really wasn't predictable. And so it's the things that surprise me that I worry about. And that's why, even if you can't identify things that are probably going to go wrong, it's very important to have a very diversified portfolio, because stuff happens and you don't know what direction it's going to come from. And because of that, I think the best protection is a very well-diversified portfolio.
Great. Thank you, Dr. Kelly. I think in the essence of time, we'll end with this last question.
Okay.
Considering bonds have an inverse relationship to interest rates, can you speak to their position as it relates to a retirement plan portfolio in the next 5 years, if and when interest rates go up?
Yeah, I think that is more of is more of a problem. I think people need to have bonds in a portfolio, but I would keep it pretty short duration. I'd recognize that they are basically a defensive asset. A retirement nest egg is just that. It's a nest egg. You don't want it to break. And so you want to have bonds in a portfolio because something could go wrong, which will cause bonds to go up, but more importantly, cause everything else to go down. So I think you do have to have bonds in a portfolio, but in a rising rate environment, I would say be a little underweight bonds, so try and get income from other areas, like dividend-paying stocks or long-short funds or various alternatives like real estate. And then also within the bond market, just keep things rather short duration, because it's long duration bonds with long maturities, which tend to be most vulnerable when interest rates rise. So I keep a pretty short duration. I just try and get income from as many diverse sources as possible. I'd be underweight fixed income overall, but I would still have fixed income in a portfolio because something could go wrong, and I just don't want to be completely victimized if something does go wrong with the global economy.
Thank you, Dr. Kelly. That will now conclude our question and answer period. If anyone has any additional questions, please feel free to reach out to the Financial Wellness Help Center at 844-ACECRT8. That's 844-223-2788. You can also email us at financialwellness@acecrt.com. I thank you all for joining us today, and once again, Dr. Kelly, I would like to thank you for taking the time to present today.
You're very welcome. Thank you.
This now concludes the webinar. Thank you.